All right, so you've got to see this. Two of the biggest names on Wall Street just dropped these huge new reports on Palantir, and honestly, it's created a real puzzle. So in this explainer, we're going to break it all down. What they're saying, where they totally agree, and most importantly, the one massive thing they just can't seem to agree on. So check this out. This is the whole thing in a nutshell. You've got Bank of America coming in hot with a buy rating, bumping their price target way up to $255. But then you have Morgan Stanley. Now they also raised their target a lot, up to 205, but they're holding back with this equal weight rating. It's kind of like saying, yeah, it's good, but let's not get carried away. So you have two of the smartest teams on the street looking at the exact same company, and they walk away with totally different takeaways. Wild, right? And that's the big question, isn't it? Both of these reports are absolutely glowing about how well Palantir is doing. The business is, by all accounts, on fire. So what gives? What's the real story here? Well, here's a hint. This isn't a debate about whether Palantir is a great company. It's a debate about what a great company is worth. Let's dig into the bull case first. Okay, so let's start with Bank of America's side of things. They are, to put it mildly, extremely bullish on Palantir. And the way they frame their whole argument, well, it's built around a really clever and probably very familiar idea. They literally title their section Breaking from the Matrix. It's a fantastic analogy. What they're saying is that Palantir is basically Morpheus holding out two pills and offering the business world a choice about its AI future. You can take the easy path, or you can see how deep the rabbit hole really goes. And here's how they break it down. The blue pill? That's what almost everyone else is selling right now. You know, these kind of generic one-size-fits-all AI tools that are really just a fancy layer on top of something like ChatGPT. But the red pill? That's Palantir. BofA argues this is the real deal, a deep, powerful, fully integrated platform that's actually built to solve a company's hardest problems and, most importantly, make them money. And this is where it gets really interesting. BOA points to a study, and this number is just nuts, that says something like 95% of all corporate AI projects fail, like they produce zero measurable results. So their whole argument is that Palantir is that rare 5% exception. It's the one that actually works. It's the one delivering real measurable value. And that's why they think it's breaking away from the whole pack. So yeah, that's a pretty strong bull case, right? But what does Morgan Stanley have to say about all this? Okay, now we're going to pivot to what Morgan Stanley thinks. And you might be expecting them to come in and just tear that whole red pill idea apart, right? But that's not what they do. Not at all. In fact, they start out by basically agreeing with Bank of America on just how unbelievably well Palantir is doing. I mean, just read this quote. It is hard to find a better fundamental story in software than Palantir. Now remember, this isn't coming from the super bulls at BofA. This is from Morgan Stanley, the cautious ones. They're flat out saying that if you just look at the nuts and bolts of the business, Palantir's pretty much best in class. There's no debate about how well the company is executing. And both banks are pointing to this one number that is just staggering, 114%. This is Palantir's score on something called the Rule of 40, which is a really big deal in the software world. So what on earth is the Rule of 40? Okay, so the Rule of 40 is basically a simple health check for a software company. It's super simple. You just add their revenue growth rate to their profit margin. And if that number is over 40, you're looking at a really, really healthy, high-quality business. Palantir's at 114. That's not just good. That's not just great. That is insane. It's almost unheard of. They're absolutely crushing it on both growth and profitability. And that crazy Rule of 40 score, it's all thanks to some absolutely explosive growth numbers that, again, both banks are highlighting. This isn't just hype. The numbers are here to back it up. Just look at this. Their U.S. commercial business, this is a huge focus for them, is up 121% year over year. That's not just growth, that's hypergrowth. It's proof that their big push to sell to regular companies, not just the government, is working in a massive way. And it's not just that they're selling more to their old customers. Nope, they're adding new customers like crazy, up 45% in a year. This shows that the product is catching on and more businesses are signing up. Okay, but this chart, this might be the most telling one of them all. This is bookings. Basically, it's the total value of all the new contracts they've signed. It's a peek into their future revenue. And that number is up 151%. It's just mind-blowing. What this tells you is that the incredible growth they're seeing right now is not a one-time thing. They have a gigantic pipeline of business lined up. So let's just pause here for a second. This brings us right back to the billion-dollar question. We've just seen it. Both banks agree the company is performing at an insane level. The growth is off the charts. So why on earth are their final ratings so different? Right. Why does one say, go for it, and the other says, maybe just wait? Well, the answer has zero to do with how good Palantir's business is. It has everything to do with one word: valuation. And boom, here it is. This table explains everything. Just look at that last column. Bank of America, the bull, is justifying their $255 price target by looking at what they think Palantir will be earning way out in 2035. That's over a decade from now. Morgan Stanley, meanwhile, is being more conservative. They're basing their $205 target on the cash flow they expect just 5 years out in 2030. So what this really is a fight about time travel. Seriously, it's a debate about how far into the future you should be willing to look to justify the price you're paying today. Do you value the company based on what it might look like in 5 years, or do you need to look 10 years down the road to make the numbers work? That's it. That's the entire disagreement. All right, so let's wrap this up. What's the final takeaway here? This whole situation is a perfect, and I mean perfect, example of the classic Wall Street debate, the difference between a great business and a great price. So let's break it down one last time. First, the agreement. Everyone agrees Palantir is executing flawlessly. The growth is phenomenal. That's not up for debate. Second, the debate. It's all about the timeline. Are you valuing this company on its 5-year potential or its 10-year potential? And that brings us to the core issue. This was never a fight about the quality of the business. It's always been about the price of that business's future. And so that leaves you with the big question, the one that every investor has to answer for themselves. We know the company's performing. The reports agree on that. The numbers don't lie. The real question is this: what's the right price to pay today for that future?